Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, as well as Patricia Zobel. She's Senior Managing Director and Head of Macroeconomic Research and Market Strategy at Guggenheim Investments. We're here to discuss the impact of data, confidence on investor behavior, and broader risk appetite. It is great to have all of you with us. Patricia, welcome to the show.
Thank you.
And it's interesting, the conversation that we're having around data confidence, and a lot of this is stemming from the Fed and its mandate to balance inflation and growth.
Yeah. So certainly, data quality is an important component of how both investors and the Fed make decisions. Right now, I think you've seen an array of challenges facing data quality in the United States. I think those really stem since the pandemic. You've seen lower response rates. You've seen challenges with seasonality, and you've seen some budget challenges at the BLS, and they're collecting a little bit less data on things like CPI. I don't think I think the Fed and market participants rely on a broad range of data in order to make decisions. We ourselves are looking well beyond the reports and think we have the information that we need to make decisions, even with some bigger standard errors in the data that we've been seeing lately.
Yeah, it feels like a healthy conversation that needs to be had, so that you're not just stuck in one lane of getting data.
I do think that the data agencies in the United States, they're extremely experienced. They have qualified people working for them, but there is opportunity to enhance the process. To me, I think the most important thing as we go through this process is that it be thoughtful, that it be implemented carefully, and that it be nonpartisan in the way that it's implemented.
Yeah, and Michael, as an economist, your job is clearly data dependent. It's what you focus on all day long. What are your thoughts around data dependency and the confidence that's there?
Yeah, I think you covered it all quite well. I think things are kind of trending the wrong direction. I'm not super duper worried about it from my personal position currently, but it's also something that you can't just let continue to deteriorate endlessly, because then at some point it will become a serious problem.
Yeah, and Chris, the markets appear, as we continue to hit all-time highs,
Yes.
which feels like a daily basis, that it's digesting perhaps how we should be thinking about data.
The trading is, when you look at the market themselves, you have all-time highs made in the S&P, the Nasdaq. The index is doing well. Small caps are doing phenomenally well since the beginning of the month. If you look at the breadth of the Russell 2000, the S&P small cap index, you're at 60% now of companies trading above a 20-day average, where at the beginning of the month that was like an 18 to a 20 handle. So risk on is really where we are in this global market push. You're seeing a 14 VIX, which is kind of unheard of this week, considering where we were at a 50 not that long ago. A few months ago, earnings have been pretty good, but there's uncertainty in the economic data. CPI was not bad, not great, not bad. The push here, I think, on this rally, now that earnings season is winding down, the uncertainty comes to tariffs.
Right.
And then the guarantee right now, Fed Fund Futures saying that we are going to cut a quarter point in September, and we're pricing in a total of 3 cuts by the end of this year. So I think that's a risk-on environment for a number of different sectors, as opposed to the AI tech tailwinds that we've been kind of feasting on for the last couple of months.
Yeah, and Patricia, you make a great point here in your notes. You have to question, is it tariff-driven, or are there structural inflation pressures?
Well, I don't think the CPI report was uniformly positive. There was some good news in the report, which is that you didn't see the types of goods inflation that people had been anticipating for months, given the tariffs that have been implemented. I think what we're seeing is that impact is being drawn out. We still expect some tariff inflation, but it could be down the line, and we're holding open the possibility that businesses are able to offset these costs a little bit or absorb them into their margins. So it's a little bit more muted than people had been anticipating. But on the other side, the services inflation was a little bit hotter than people had been thinking, and that was really being driven by recreational services, medical services, and these are things that reflect underlying demand in the economy. And so it wasn't a uniformly positive report, but we think that it keeps the Fed on track for easing. It's good enough. And I think what that does is, given the tangible labor market weakness that they're seeing, they're going to focus a little bit more on that side of their mandate. But what they're probably going to want to see is some confirmation in the August employment report that softening labor market is a trend that needs to be addressed in September.
Which is what makes our balancing act so challenging. Was it too late? Could it have been too soon? If the economy is continuing to chug along like it has been, is it necessary to even cut rates? So it's been a really challenging balance act. And for all intents and purposes, while the pandemic's in the rearview mirror, there still are some after effects, and we don't really have a roadmap for that. So that there are still some things that they need to balance out.
Yeah, it's not surprising that you have a diversity of opinion on the FOMC. There's a lot of shocks hitting the economy right now, and that includes tariffs, immigration, and there's coming fiscal stimulus. And what you see is that some FOMC participants are focusing on the labor market vulnerabilities and the fact that they're pretty confident that tariff price increases will be a one-time shock. So Bowman and Waller dissented at the last meeting. Other FOMC participants are not as sure about that tariffs will be a one-time price shock, and they are anxious not to make the mistakes of the pandemic. And for them, the unemployment rate has been relatively stable. We see underlying weakness in the labor market, but they've been waiting for more information. On balance, I think the committee is going to tip more toward wanting to make a move, focusing on the employment side of their mandate in September, particularly if the August employment report shows the kind of underlying weakness that we saw in July.
Yeah, and Michael, we've discussed this before, where a tenth of a point isn't really necessarily going to move the needle. So what would get you concerned about what you're seeing with the employment numbers? What are your thoughts in terms of getting cuts in September?
Yeah, I think, well, I guess to play devil's advocate on the cuts or no cuts scenario, I do agree that it seems likely that September is what will happen, that there will be a cut. But would any of us be surprised if we get a stronger than expected jobs report next month and maybe hotter goods inflation? That then things kind of get a little bit muddier. So I think that can't be fully discounted. But in terms of what to look for in the jobs numbers, I think also people need to recalibrate what a decent jobs number is, where we're in this period where we have much lower immigration. So the kind of break-even jobs number is going to be a lot lower than people were used to even last year. So I think there's some recalibration around what you see there in terms of what's a healthy labor market. But we are clearly in this period of low hiring, low firing. And I think the kind of best way that I've seen it is if you look at 2023, 2024, 2025 initial claims overlaid, they look the exact same. But then if you look at continuing claims overlaid, it just moves up and up and up. And so people that have been laid off, it's getting harder and harder to find a new job. And so that's just kind of a slow grind that we've seen to the labor market, just getting marginally worse really over time.
Yeah. What's the market pricing in terms of rate cuts? I mean, what, 93%?
Right. We're 3 cuts by the end of the year. Mm-hmm. Some think there might be a little bit more. We'll see. Like the chairman said the other day, we get 4 reports to look at before September. It'd be kind of interesting if they throw a half a point out like they did last year. That would really push this market higher out of the gate.
That's got to be helping small caps.
Well, look, that's what Russell 2000 just had a golden cross on the chart in the last week and a half. It's a fantastic move. That bodes very, very well for people who are investing in small caps. It also bodes well 3 cuts, especially for the smaller cap companies that are cash burn, who have to refinance on an annual basis or so. It's going to come a little bit cheaper for them, which means they get to keep a little bit more of what they actually need to raise. And if you're a mid-cap or a larger company that needs to raise money out there, it comes at a better rate. Mm-hmm. So that's, again, very good. Plus the tax changes have taken place. Companies are seeing more flow to the bottom line. So there's going to be more cash in the market depending on the company's status, whether cash burn or not. Markets are looking to push higher. I mean, multiple days higher over low. Like I said earlier, the breadth is very, very good. The VIX is very low. It's almost like it's priced to perfection here.
Right.
And you're not seeing, like I said before, the tailwind from the AI tech movement moving along, pushing everybody else higher, rising tide type of metaphor. So consumer is, switch back on the macro side, consumer is a little bit of a concern here, especially lower income versus higher income. If the lower incomes consumers start to spend a little bit more, if they see a little wage growth, right, and they can hold on to their jobs, that's a good tailwind for a lot of companies that are dealing to that sector. When you look at the retail companies, May and June saw dozens of companies pull back guidance. If they can start to put guidance back out there and give an idea of what the consumer spend is from their point of view, that would be very good. We'll get a couple of good looks at the end of this month. Walmart and Nvidia are both going to report. That's going to help out a lot there. I wouldn't be surprised if the markets push higher than fall back after Labor Day.
I think, Patricia, what's interesting when you examine consumer data, it's not necessarily publicly available, but if you have access to some proprietary data from how consumers are spending, I think that's key. What kind of liquidity are they accessing to spend? Are they becoming over-levered with BNPL, as an example, which, by the way, is going to start to be reported to FICO? I think that's going to be key here, how they're spending.
Absolutely, and what we've seen for a while is that lower income consumers have been under pressure, and what you've been seeing is increasing delinquencies in credit cards and autos and now student loans. On balance, we haven't seen that cohort, really drag overall consumption down. I think what we've been seeing in recent months is really caution around volatility. You've seen discretionary purchases come off the boil. People have eased up on discretionary purchases. They were traveling less and things like that. So to us, it reflected a cautious consumer. Savings rate was going up a little bit rather than the lower income consumer under stress really dragging down consumption. You have seen consumption really stall this year, and on a 6-month basis, personal consumption is roughly flat. It isn't contributing a lot to growth now.
Well, it's kind of a double-edged sword because it is a good thing that consumers are saving or they're paying down debt. Perhaps some lessons were learned from COVID and understanding that, not discretionary funds, but necessary funds. Hopefully that was a lesson that was learned.
Well, certainly we are seeing that. They are being a little bit cautious. They're saving a little bit more. I do think for the lower income consumers, this is a time when they're really under pressure. It's very difficult for them to have that cushion of savings that they would like to have to address anything that comes up. So they're an area to watch.
Yeah. Kind of an abstract question, Michael. We'll save this one for you. As it relates to the housing market and people are saving, waiting for rates to go down, hopefully affordability will be accessible. Do you think savings rates are reflected by that, or people are just hoarding for those reasons? Is that part of the calculus?
I think it is more just the cautious consumer kind of aspect, because it is more of a recent kind of thing where you see the savings rate rising in the last few months here. So probably not long-term, I'm planning to buy a house, 5 years from now kind of driving of that. So I suspect it's probably more just there's a lot of uncertainty going on. Maybe I could lose my job, so I'm just going to save a bit more than I would have otherwise.
Yeah, it's interesting, Chris, parsing out these headlines because the market, and of course, it's one thing we have to remember is the economy and the market are two very different things.
We've said it a couple of times today to companies when I talk to them, stocks aren't companies, companies aren't stocks. Right. Stocks continue to do very, very well. Some of the companies are still struggling a little bit. And some companies are doing very, very well, but their stock is struggling, sometimes for very different reasons. I think that the market here is in a strong place with, as I mentioned before, the breadth. I'm harping on that a lot because it's really, really changed significantly for all the major indexes. The Russell, the S&P, the Nasdaq 100 is starting to fall back a little bit on that. The Nasdaq Composite's actually a little underwhelming, but the S&P 500, the S&P Mid-Cap 400, and the S&P 600, all very much stronger. So that's telling me that investment flows are being put to, people are putting money to work. The 10-year continues to come down. Follow the 10-year, you follow the market. I think we're at 4.23% right now. Lower VIX at 14. Tells me that it's a risk on. People are putting money into equities right now, and that's not going to stop at any time soon.
Yeah.
We'll see what happens in September with the Fed cut, or at the end of this month when the de minimis tax comes on, or if that gets punted. You know, there's a lot of the tariffs are putting a lot of pressure on, especially with trade coming out of India and China right now and everywhere else. It's an uncertainty that we just really can't. You can't put your finger on it.
Right.
And that's what's hurting a lot of the companies, especially on the front-facing side there.
But Patricia, to wrap up here, that's what participants were waiting for, was this broadening out of the Mag 7 trade, which is a positive sign.
Certainly it's a sign of that the risk sentiment is improving to the broader market, and people are becoming a little bit more optimistic about things broader than AI. I mean, what you've had from an earnings perspective is technology-related companies are really carrying earnings and delivering super strong results. So the Fed is even dealing with something that's a little bit like a bifurcated economy, where some of the parts of the economy are doing very well, some parts are doing less well. But I think it is, you know, what you are seeing is now with rate cuts being priced in, sentiment is turning a little bit more positive, a little bit more broadly. I think the risk is something that's been mentioned before, whereas I think on balance the Fed is going to ease in September. If you were to get a more positive labor market report that just holds it in, or some inflation numbers that were a little bit less friendly than they were today, you know, that could become less certain, and I think that would be a risk point for the markets.
Right. Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.